Hello and welcome back to the Art of Finance. In this video we'll be going over the key differences to mutual funds, index funds and ETFs. Mutual funds are pools of money from many investors that invest their money into securities such as the stock market and bonds. This creates what we call a portfolio, a combination of different holdings in stocks and bonds. Investors can buy shares in mutual funds. Each share represents an investor's part ownership in the fund and the income that it generates. These funds are professionally managed by fund managers that aim to outperform the stock market. They handpick securities and monitor the performance, providing you with the highest possible return. The pros: professionally managed. The main reason why you want to invest in mutual funds is great for people that are not stock savvy and are beginners. This allows you to invest your capital in the stock market knowing that it is looked after by professionals. This eliminates the time and effort required before investing your money. This is great if you either don't have the time to invest into the stock market or simply don't understand it. As a rule of thumb, always know what you're investing in as your capital is at risk. Mutual funds are quite diverse, minimizing the risk of putting all your eggs in one basket. Fund managers invest in different industries and sectors, offsetting the risk of being only exposed to similar sectors. This dramatically lowers the risk, as if one sector or companies are failing, you are invested in other companies and sectors that are performing well, balancing the portfolio. The credibility of the fund managers is usually based on the returns from their fund's past performance, but it's not as important as you may think, because past performance does not predict future returns. But past performance can tell you how volatile or stable a fund is that has been over a time period. The more volatile the fund, the higher the investment risk. Laid back. This option is excellent for people that have the spare cash to invest but don't have the time or simply don't understand how to use their capital to generate a return on their investment. Typically, this can be someone who is much older in their lives or someone who doesn't have the time to learn what to invest to. This option is also great as it is looked after by trained professionals that are actively managing the portfolio. So if anything goes wrong, they are there and they are actively managing it. Liquidity. The best thing about these funds is that they can be bought or sold at any time. So you can withdraw your money whenever you feel like it, similar to stocks. This is great as your money is not held hostage compared to a fixed ISA account waiting for maturity. Cons. Cost. So far it sounds excellent, but what's the catch? Management fees. Since all the work is being done for you, or in other words, actively managed, there are hefty management fees to pay that diminish your overall profits. The fees may seem small, but overall in the long run it will cost you thousands of dollars. This is the biggest con of mutual funds. Limited time for growth. Another issue with mutual funds is that the stocks and bonds are always sold in short periods. Generally, you would want to hold onto your stocks between 3 to 5 years before even thinking about selling. This allows the stock to grow over time so that you can sell for a good return between 5 to 8%. Fund managers are always selling and buying different positions to either minimizing losses or profiting from small gains. The issue with this is that this is very compulsive, selling and buying. This can be very similar to gambling. Human nature has a natural tendency towards gambling, the unreasonable risk of claiming the prize or avoiding a potential loss. This risk-taking behavior is more tempting as the reward increases. If you don't believe this, think about all the small noticeable gambles we do daily, such as texting while driving, eating too much of the wrong food, or sleeping in that extra 10 minutes with your job on the line. This generally happens a lot more when it comes to day trading in comparison to when investing in mutual funds, but this is something to consider, that this is what the fund manager is doing on a day-to-day basis. Capital gains tax. The price of the security in a fund may increase. When a fund sells a security that is gained in price, the fund has a capital gain. At the end of the year, the fund distributed these capital gains minus any capital losses to investors. Index fund. An index fund is a type of mutual fund or exchange-traded fund that seeks to track the returns of a market index such as the S&P 500 or the FTSE 100. A market index measures the performance of a basket of securities, like stocks or bonds. This is meant to represent a sector of the stock market or the economy. Index funds are not actively managed like mutual funds, but are passively managed, following an index that helps you whether or not to decide, as if you could track the performance of the stock market dating back many decades. This means they aim to maximize returns over the long run by not selling and buying securities very often. This is excellent, as one of the most popular indexes is the S&P 500, which allows you to be invested in the top 500 companies easily with a click of a button. This minuses all the individual fees that would have incurred to yourself if you did it yourself. I always suggest everybody to invest in index fund, as the risks are considerably lower compared to mutual funds and fees. These fund managers are aiming to beat the stock market with better returns, which has only been seen by the greatest 1% of investors such as Warren Buffett. The pros. Index funds take on the passive investing strategy. This means they are not actively managing their account. The fees on the index funds are low because there is no active management. ETFs are often index funds, and they generally have the lowest fees of all. They can save investors money throughout their lives, since less of their investment gains go towards fees and expenses. This provides you with the lower overall cost to shareholders, meaning that you keep more of your profits. Flexibility. There are also disadvantages to using index funds for investments. The lack of flexibility limits index funds to well-established investment styles and sectors. So upcoming sectors like cryptocurrency are not included, or if you wish to invest in a stock outside the index, the lack of flexibility limits index funds to well-established investment styles and sectors. So up-and-coming sectors like cryptocurrencies are not included. Or if you wish to invest in individual stocks that are not included in the index, that wouldn't be an option. This requires you to find another platform to invest in the stock that you would like and feel that you can have a huge return in. This also means that if the index is also doing bad, so will your investment, as it is closely tracking the index. Limiting returns. An index fund does not carry the potential to provide a massive return if one of the stocks skyrockets. This is because your capital is spread across many different stocks. Although you are limiting the amount of risk, you are also limiting your returns on singular companies skyrocketing. This is where your risk tolerance comes into play. If you have a high risk tolerance and are making a surplus in cash to invest with, then investing in singular companies can provide an excellent return. But remember, it's a double-edged sword with a heavy price to pay. An ETF is an exchange-traded fund, since it's traded on an exchange just like stocks. The price of an ETF will change throughout the day as the shares are bought and sold on the stock market. This is unlike mutual funds, which are not traded on the exchange and traded only once per day after the market closes. Additionally, ETFs tend to be more cost efficient and more liquid when it comes to comparing it to mutual funds. ETFs provide lower average costs, since it will be more expensive for an investor to buy all the stocks held in one ETF portfolio individually. Investors only need to execute one transaction to buy and sell, which leads to fewer broker commissions, since there are only a few trades being done by investors. Brokers typically charge a commission for each trade. Some brokers even offer no commission trading on certain low-cost ETFs, reducing costs for the investors even further. An ETF ratio is the cost to operate and manage the fund. ETFs have low expenses since they track an index. For example, if an ETF tracks the S&P 500 index, it might contain all of the 500 stocks from the S&P 500, making it passively managed and less time intensive. However, not all ETFs track an index in a passively manner. So the key difference between ETFs and index funds. An index fund can be an ETF, but an ETF cannot be an index fund. So ETFs are very similar to index funds. And the key difference is that index funds can be ETFs, but ETFs are not all index funds, as not all of them follow an index. The pros. Access to many stocks across various industries, low expenses ratios and fewer broker commissions, risk management through diversification. ETFs exist that focus on targeted industries. The cons: actively managed ETFs have higher fees. Single industry focused ETFs limits diversification. Lacks the liquidity, hinders transactions. Index stocks ETF. An index stock ETF provides investors with the diversification of an index fund, as well as the ability to sell short, buy on margin, and purchase a little as one share, as there is no minimum deposit required. However, not all ETFs are equally diversified. Some may contain a heavy concentration in one industry or a small group of stocks or assets that are highly correlated to each other. Dividend and ETFs. While ETFs provide investors with the ability to gain as the stock prices rise and fall, they also benefit from companies that pay dividend. Dividend are a portion of earnings allocated or paid by companies to investors for holding their stock. ETF shareholders are entitled to a proportion of the profits, such as earned interest or dividend paid, and may even get a residual value in the case of the fund is liquidated. So, I hope that covers what the differences are between the three. As a takeaway, I would suggest beginners to invest in an ETF that tracks an index fund. This could be the S&P 500 to the FTSE 100. This avoids the expensive fees of actively managed portfolios and tracks the performance, not aiming to beat the market, but to have time in the market, following its growth over time. It's not quick and flashy as we would like it, but it comes with one of the greatest possible ways to invest your money without losing it. If you have enjoyed this video and have learned something, please hit that like button and subscribe for more. This has been The Art of Finance. Peace.